Hello and welcome to all of our attendees today for our webinar, What Business Leaders and Regulators Want, Managing Third-Party Risk in Financial Services. And I'm Tim Cummins, the President at ICCM and moderator for today's session. So before we get started, a couple of quick housekeeping items. For those who always ask, will we receive a copy of the webinar slides and recording? The answer is yes, you will receive that by email. And secondly, we do, of course, very much welcome any questions throughout the program. Please would you use the chat box in the control panel, probably on the right-hand side of your screen, at any point as we go through, and we will be monitoring those questions. So let's have a quick overview of the organizers. We have three organizations behind today's webinar. First of all, Promontory, which is an IBM, a global unit of IBM Corporation. And as you can see, it provides advisory and implementation services around regulatory and domain expertise. ICCM, the International Association for Contract and Commercial Management, and our focus is on helping organizations achieve world-class standards in contracting, relationship management. And finally, Syrian Labs, a global leader that is actually transforming the contracting engagement through very much integrated technology, which really supports much greater collaboration, both internally and externally across organizations. So those are our three organizations, and what we're going to be covering today is firstly, why it's critical for organizations to get on top of third-party risk management. Secondly, we're going to talk a little bit about the regulatory expectations from financial institutions in respect of third-party suppliers. And third, and particularly importantly, I guess, the role that technology is actually playing in the effective management of third-party risk. So let me just give a quick introduction to the people that you're actually going to be hearing from today. And first on our list is Robin Shahani. Robin is Managing Director at Promontory Financial Group. He's the executive responsible for global strategy and optimization practice. Now, Robin and his team focus on driving efficiency and effectiveness in risk management programs, and looking particularly at the three lines of defense with which many are probably familiar. He's had roughly 25 years in his career and worked at leading financial institutions prior to Promontory, places such as Citigroup, American Express, and TD Ameritrade. Ajay Agrawal is a long-term friend of ICCM and has been involved with us in a variety of manifestations in a very entrepreneurial career. He is co-founder and CEO at Syrian Labs, and certainly has demonstrated himself as a product visionary in the strategic and legal technology space for some 20 years. Prior to Syrian Labs, he was a founder of United Lex Corporation, which many will know of as the leader in legal process outsourcing and strategic legal technology. He's worked as a securities law expert in some of the world's leading firms and investment banks. And finally, myself, Tim Cummins, president at ICCM, actually these days also a professor in the School of Law at the University of Leeds, and again from a practitioner background, which included, Robin, rather before your time there, some dozen or so years at IBM Corporation, and also prior to that in the aerospace, automotive, and at the beginning of my career, in fact, the banking industry. So that gives you a sense of the people you're going to be hearing from today, and we'll now get started on the substance, if you like, of our discussion. Let me just, if I may, give a very quick background to this. What is the current state of third-party risk management? Well, some interesting data points here. a recognition certainly that the economic and operating environment for the banking, financial services, insurance sector is one which is increasingly demanding, and that the amount that is spent, the demands, if you like, of building robust governance systems is something that itself needs focus on in order to maintain an affordable level of cost. And Robin, I'll look forward to maybe hearing one or two of your thoughts on how do organizations actually streamline to manage affordably in this risk environment. In terms of the investment that's been made in managing third-party risk, interestingly, this particular study from 2018 by Deloitte indicated that only 21% of the organizations responding feel that they today have made investments that cover all or most risks, clearly pointing to the fact that whether it's at a resource level or a technology level, they still have some substantial way to go. On leadership, while responsibility is very clearly with the board and executive levels, there's a real challenge in how you actually coordinate and train and develop the stakeholder capability to actually manage risk on a day-to-day basis. And that, of course, translates into this problem of what is the ideal operating model? And some 70% seem to have concluded that it needs to be a federal initiative rather than a centralized initiative. But on the other hand, it also has to be strongly supported through centers of excellence. And finally, we recognize this need for this three-tiered approach, which I mentioned already in the introduction. And those have to be enabled through smartly coordinated investments in the right technologies. So that, I hope, gives us a clear sense of the challenge that we're facing. And perhaps we can move then to our first question. So despite the significant spend and focus by financial institutions on improving compliance, the scale of issues and penalties is truly massive, not just significant, but massive. So, Robin, what do you see that's going on here? What are we missing?
Well, thanks so much for the introduction. I think there are a number of factors going on here. The ecosystem of third parties, and let's focus for a moment on supplier third parties. The ecosystem of suppliers that banks and other financial institutions are using is getting increasingly complex, increasingly strategic, and increasingly interrelated. So the dependency is going up. The requirements are getting more sophisticated as regulators and others improve in the space and really understand what true risk management is, and moving away from ticking the box type exercises. And so, we see a greater proportion of spend going toward external partners for innovation, for operations, for technology applications, and so on. So I think a complicated environment, increasing dependency, interrelatedness, greater requirements to deal with risk issues and urgency to deal with them. And perhaps most importantly, and this is really more of a risk point than a third-party management point, financial institutions are not sure which smoldering risk issue is going to pop up next. And this is even more complicated to deal with when it's not your issue, it's actually a supplier's issue. And so there are a variety of those factors that are coming into it. And then finally, I'd say CFOs are cracking down. There's enough already with all the spend on risk and compliance. And so there are opportunities to take cost out by using, COE offshore type operating models, new technologies to help with data analytics, AI-driven insights, all sorts of stuff like that. So complicated ecosystem, demands on the folks running these organizations, suppliers that are getting fed up with the process, customers that are frustrated with how slow it is to do business, variety of factors coming together at the same time. Perfect storm.
Yeah, tremendous insights. And Ajay, have there been other changes that you've observed?
Yeah, one thing, thank you, Tim, and thank you for that warm introduction. One of the things that I think is possibly worth pointing out, and I think Robin has alluded to that, is the historical shift that's taken place in buying propensity, particularly in the financial sector. And I think if one takes a snapshot of the last 20, 25 years, there's been a very marked concentration in the propensity of financial sector organizations, particularly insurers and banks, to outsource a lot of the strategic activities such as facilities management, telecom, IT, etc. These are areas that used to be areas of internal operations under the heads of facilities, under the heads of real estate, or the CIO, to external suppliers. And as Robin pointed out, as this dependency has increased over time, the complexity of these relationships has also gone up. I think starting this outsourcing trend may have started in the early 90s, and roughly about a dozen years ago, let's say 2005, 2006 onwards, the tendency to rely on monolithic, one-size-fits-all buying arrangements with jumbo suppliers has given way to a tendency towards point arrangements or best-of-breed buying arrangements, where it's been the tendency to work with specific third parties who are the best of breed in any given area, and then to rely on a service integration and asset management philosophy in getting multiple such third-party suppliers to collaborate with each other and deliver the end outcome to the buying organization. This, of course, ties in very closely with the permissive posture of the regulators. The regulators in general have been permissive in allowing the regulated entities in the financial sector to go ahead and enter into these buying arrangements with their increased levels of complexity. The requirement, of course, has been that they demonstrate not just scrutiny over the entry of these arrangements, but also ongoing and periodic assessments of those relationships, and in particular the operating side. And we will get a little bit deeper into that as we go further. But that, I think, is the kind of historical evolution over the last dozen years or so. Back to you, Tim.
Yeah, fascinating. So, Robin, you talked about interdependency, and of course, what we're hearing there is it's not just the nature of the interdependency as it's changed, but of course also the scale of it. So, what does that mean is at stake really for financial institutions if third-party risk isn't adequately addressed? What do you talk about and hear from your clients in that regard?
I think increasingly the expectation, whether it's regulatory or otherwise, is kind of twofold. One is don't confuse effort with results. The other is that regulators in particular are not particularly sensitive to the financial issues, the efficiency or inefficiency associated with these programs. So finding a way to do it more effectively at the same time as you do it more efficiently is pretty critical. If you screw that up, right? So if you screw up effectiveness in particular, you really see, have the regulators coming down on you particularly hard. The bar has been coming up over time. The expectations are greater and greater now that there's more sophistication in the marketplace. And so you have to kind of comply with that. The complexity in this, as you know, is that financial risk historically is where the action has been going back 20 years or so. That was managed by a few trained subject matter experts centrally. Third-party risk, non-financial and operational risks are like sustainability. They're the responsibility of every citizen, right? And so it is very difficult to change the culture of an organization, to change the awareness, to train these tens of thousands of people, and to get everyone to comply and take this seriously. Really understand what their responsibilities are, what the company's obligations are, and do something other than, again, tick the boxes. And I think to me that disconnect between I do a risk control self-assessment or I do a third-party assessment because I want to either game the system to get this off my desk or I don't really know what I'm doing, so I'm going to check a bunch of boxes and see what happens because somebody else is going to deal with it. Well, that somebody else doesn't really have the insight that you do if you're close to that purchase. And so it's really, really important to get everyone on board. It's a new reality of doing business. Supply chains are going to require this level of expertise in a decentralized way. You know, we talked about the federated model earlier in your introduction. I think that's great once there's some maturity and some skill and a culture of doing this. But until that time, I'm a big fan of starting with a centralized model, moving to a center-led model, and then eventually to a federated model as maturity increases. It is incredibly important. One other example that I think is worth mentioning, and you see a lot of companies, even large companies, trying to do the most innovative incubation in partnership with third parties. That creates a great deal of complexity in terms of how, you know, a company like major global bank is not used to dealing with 5 men and women in a garage doing an innovative exercise, and finding the ability there to manage your risk, compliance, legal, commercial kind of requirements is very difficult. You need to find a way to challenge those, build a program that's flexible enough to deal with that, because that's where innovation is going to come from and keep the company moving forward in a competitive way.
Yeah, I think that's absolutely a critical issue. Certainly we hear a lot or observe a lot as the challenge, and probably a good topic for a follow-up webinar in its own right. If I may, just a quick yes or no answer from you on this one. In some industries, we obviously see one of the consequences of this being a tendency to look more at insourcing. Do you see that happening at all, really, within the banking financial services sector?
Yes, we see it as a theme. It's driven off the complexity from a risk and control and compliance perspective, but also financially. People have realized that managing teams in a far-flung part of the world, if they don't have other operations there, is too complicated. So both reasons, both financial and risk and compliance.
Okay, so, well, let's move back to you, Ajay, with the question on this one. How is it that how do you see regulators viewing third-party relationships?
Yeah, no, great point, Tim. And I think one of the points that's worth mentioning is that whilst banks and insurers have been relatively and historically adept at navigating market risk and credit risk, the two pillars of the Basel II framework, the complexity injected into operational risk, which is the third element of the Basel II framework, has been possibly the most challenging and the most demanding, particularly over the last decade or so. And in this operational risk element, the oversight of the complex third-party component is the one that has required the greatest attention. In the wake of Lehman, let's say in 2008, the regulators' attention on the ability of a bank or an insurer to outsource key functions to those, let's say, outsourcing outsourced third-party service providers is there. But instead of just focusing on the upfront risk of how we onboard those third parties, the ongoing monitoring of their performance, of their compliance, of their adherence to the contractually stipulated performance parameters, that I think is where some of the biggest gaps have opened up. And I think those gaps have opened up between the letter and the spirit of the regulations that are out there. For example, if you look at one of the most seminal OCC bulletins of 2013, which talks about how third-party relationships should be viewed, I think that the bulletin's focus lies on the actual performance and the operational risk created by that of the third party. Whereas if you look at the conduct of this by banks and insurers, they have focused largely, as I said, on the front end risk that's created rather than just the upfront, rather than the ongoing elements. And I think that these failures in performing the ongoing have intensified as a result of which the regulators have interpreted these key regulations and underlined these requirements to intensify these oversight and express their concern that the quality of risk management over third-party relationships may not be keeping pace with the increased complexity of those relationships and the outcome orientation of those. I think it's fair to say that one of the key elements of the journey over the last 15 years has been a movement away from buying resources or resource-led buying arrangements to outcome-led arrangements or performance-led or consumption-led buying arrangements. And I think as this transition has taken place, that has only added to the difficulties in exercising the ongoing oversight.
Robin, we obviously hear quite a lot about the Trump administration potentially easing up some of the regulatory environment for banks and financial services, and we obviously still see levels of disparity and inconsistency around the world. But do you perceive essentially that the core principles, if you like, related to third-party risk management are pretty consistent?
I think so. I think what we have is a bit of a reprieve in the kind of bureaucratic aspects of the regulation, but I think the spirit survives, quite frankly. And I think, honestly, good third-party risk management is not just for regulators. It should be a focus for the business in managing its own risk anyway, which doesn't change regardless of administration focus.
So one of the things that we've been doing at ICCM actually is looking at what leading practices would look like for better management of risk and indeed also opportunity, Robin, to your earlier point, because we certainly from our research take the view that not just banking and financial services, but actually most industries are really struggling in building an effective and structured approach to the way that they engage with the market, both from a risk and a contracting perspective. This slide actually is a very high-level depiction of our views of how organizations need to increasingly think about segmenting their relationships and then deploying capability around the segments where they want to do business. So our findings, and this is certainly true in banking financial services, are that a lot of resource and effort has been placed in that block A, which is a very sort of strict compliance and bottom line risk management focus, and far too little has been placed on opportunities for incremental value, where there needs to be a far more dynamic yet disciplined compliance style. And one of the factors that's critical in all of this, it is just one, but it is a critical one, is of course the technology that's deployed. And so maybe we could just sort of move to that question, Robin, in the sense that what do you see as the role of technology in this area? And what do you see as some of the current gaps?
As I said earlier, I think this the advent of kind of AI and data analytics methods is really pretty fantastic when it comes to what's come to be known as reg tech, regulatory technology. It's a core part of why Promontory became a part of the IBM family with the core AI and data analytics capabilities that IBM has and the regulatory knowledge that Promontory has. And we've found a great deal of success in simple applications like, historically people have managed third-party risk or even risk more broadly, issues and logs in long text, free-flowing, unstructured data. The ability to go in and identify themes and information out of contracts with tools that are out there, Sirion being one of them. I think smarter GRCs, all that sort of stuff is really pretty amazing. The other thing that's incredible is the task of integrating the kind of multiple point solutions that are prevalent in the third-party risk management landscape tends to go away if you can put in place a very simple kind of integrating layer on top of it that becomes a user interface that's more palatable than kind of going to all these individual systems. It pulls together information into a consolidated workflow and so on. I don't see, I think individual tools are getting smarter, but I think these kind of integrating overlay hub type tools are going to be the wave of the future.
And maybe I can turn to you, Ajay. You're certainly in a pretty good position to understand where those gaps are.
Thank you, Tim. And let me just add to what Robin said. I think that Robin is absolutely spot on when he talks about the challenges of leveraging advances in ML, NLP, and AI to use and interrogate unstructured data from a variety of sources. He's also spot on when he talks about the imperatives in data science to look at the various types of data that's coming in on third parties and to create that holistic or integrated picture of the larger engagement. And I think while the bulk of the procurement budget is going on purchasing services and such engagement, as we pointed out, are inherently more complex than buying goods or commodities, I think it's worth noting that in high spend categories such as IT, virtually 80 to 90% of the total spend is concentrated with 10 to 20% of the suppliers. So taking a uniform data container approach, taking a uniform hygiene approach to managing these third parties, which has been the approach advocated conventionally by P2P systems or by GRC systems, because they are fundamentally hygienic systems, completely misses the point. I think the historical reality has been that the spend and therefore the risk has become concentrated in a subset of the third-party supply base, whereas the technology, the management approach has emphasized a uniform approach to managing the third party. So these two are dissonant developments in the sphere of risk evolution and the technology reflex that accompanies that. And I think as we double click on this small subset of complex and critical supplier relationships, we have been advocating throughout this last half an hour a deeper management approach which addresses specific types of risks that are not being addressed by the conventional GRC or P2P approaches in areas such as contractual risk, a performance risk, and financial risk specifically, where a more granular obligation level, service level type of approach is needed. And frankly, one needs to move away from relying on the self-reporting approach of the suppliers to being able to either audit them manually, which is one approach, or leverage technology to audit the supplier's performance as opposed to the promises that are inscribed inside the contract. I think the advanced automation and integrations that are needed are critical to achieve this consolidated and automated picture.
Yeah, this is truly incredible stuff, and I think the ability to kind of go in and get real-time data on performance and risk issues is going to be a game changer going forward.
Indeed, and I think the critical points here, and again, absolutely supporting the research I was showing earlier in terms of that need for better segmentation and the avoidance of fragmentation. It is that point that you need to have this unified view, and it has to be delivered across the life cycle. And you're right, Ajay, that many of the organizations we work with certainly are sort of hamstrung in a way by trying to force P2P type systems provide this sort of capability, which of course they cannot, they were not designed to do it. So I'm very conscious of time. So Ajay, why don't I just let you quickly expand on this, what I think is our final slide.
Thank you, Tim. And I'll be quick in my remarks because most of these points have already been made by Robin and by Promontory in general, emphasizing that the OCC and the Fed regulations are prescriptive and cover the entire breadth of the third-party engagement, whereas the management reflex has been focused on the left-hand side on implementing a GRC and, in a sense, checking that box, which has created problems on the middle and on the right when it comes to monitoring the ongoing financial risk, but even more particularly the ongoing supplier and the contract or the in-life risk that's there as part of the larger operational risk of that third party. So I think we have been making those points, Tim. I think this diagram is a perfect illustration of that gap that has opened up in the life cycle of a third party engagement.
So I guess on the positive side, there's plenty of opportunity. And I guess the good news is, as has been emphasized, that there are emerging technology solutions that really can begin to address the twin problems, or the trio of problems, really, of managing risk at an affordable level, actually giving the visibility and insights that are needed, and a deployment that really can promote organizational capability to take a life cycle view. So what next? We, I'm afraid, have run out of time when it comes, I think, to the questions, unless you tell me otherwise, DJ. And I'm sure that any that come in, there will be every effort to make sure we respond to them. But what we would ask you to do, if you could, please, is we'd love to have your feedback at the end of the webinar. We'd also like to remind you, you will get a follow-up email with a copy of the slides and a recording of this conversation. And we can certainly promise you that there are going to be more similar events to this one, probably tackling one or two of those big issues that we've highlighted on the way through as still really requiring greater depth of analysis. So let me, if I may, just pass to you, Ajay, for any final comment you would like to make.
No, I think it's been very useful. We thank you, Tim, for being such a great moderator, and in particular to Robin for setting aside his time.
So
thanks for having me.
Thank you, Robin, for your experience and insights to our conversation, and to our audience, of course, for participating today. And you will be hearing from our friends at Syrian Labs very soon with the output of this and answers to any of your questions. So thank you, everybody, and goodbye.